Good morning, everybody. We'll just wait for a couple of seconds for everybody to join in, and then we'll get started. Good morning. Welcome to Tax with Sax. This is our first of our quarterly webinar series where we will be bringing our in-house tax specialist to discuss any current developments and hot topics in tax. So we are pretty excited about launching this quarterly webinar series. I'll start off with our disclaimer that our firm provides this information in the webinar presentation for general guidance only, and this does not constitute the provision of legal advice, tax advice, accounting services, investment advice, or any professional consulting of any kind. The information herein should not be substituted for a consultation with your professional tax, accounting, or legal advisors. Before making any decision or taking any action, you should consult a professional advisor who has been provided with all pertinent facts related to your particular situation. Some housekeeping items. This webinar is being recorded, so you don't really need to take down notes. You will receive an email of the presentation along with the slides. If you have any questions, please feel to put them in the question section of this presentation, and we will try to get to them at the end of the webinar, but if you're not able to get to them, we will probably reach out to you separately via email and contact you. For those of you looking for CPEs, I need to read this out. Participants must stay connected to go to webinar for the entire duration of this presentation. We expect this presentation to run about an hour and a half, which means you will get 1.5 tax CPE credits. Participants must answer 75% of the polling questions. If you have difficulty answering the polling questions, that is, if your answer does not register, hit the escape key to minimize your screen and try again. If this does not work, please type that into the chat box. The participant course evaluation is in the handout section of the control panel. It should be printed, downloaded, completed, and mailed to jtoshi@saxllp.com to receive the CPE credit. Our email address can also be found on the form. So before we get started, I would like to introduce our presenters for today. My name is Shivani, and I'm a tax partner at Sax. I have with me today Craig Casano. He is part of our private client service practice. I have Michael Benguigui here, who's part of our real estate practice, and then Frank Santrella, who is part of our controversy group. Just going over the agenda for today, we'll discuss cryptocurrency in detail, the taxation of cryptocurrency. We'll just have a very top side overview of cannabis. We probably will have a more detailed webinar at a future date discussing ins and outs of cannabis and what everybody needs to be aware of. Craig will then go over the Biden tax proposals. He'll go over the highlights on the income tax side as well as the state tax. Michael will discuss the status of opportunity zones and then, what's in store for us with respect to 1031 exchanges. And then finally, we'll wrap it up with Frank, who's going to give us an update on the Irs enforcements. And then a lot of states are actually enacting the entity level tax. So he's going to give us a quick update on that. We have about 10 or 12 states who are now on board with the entity level tax. So before we get started, we'll start off with our polling question number 1. I'm looking for predictions here. How much do you think one Bitcoin will be worth in 2025? We think it's going to be 0. It'll go out of existence. 100,000, 50,000, or 250,000. If you're looking for CPEs, please select one of the answers, please. I see about 40% of the vote in so far. I'll leave it on for about 10 more seconds and then we close it. Okay, we are at 84%. Margaret, can you close the poll, please? Okay, 50,000, 34% of of the people say. 90% actually feel it's going to go up to $250,000, and 18% think that it will go out of existence. Okay. Next slide, please. So I'm going to start off with a little bit of history of cryptocurrency. Bitcoin was first created in 2009, so it's 12 years old. Seems like yesterday. There are over 5,000 cryptocurrencies today. 2,000 of them are dead coins. That means either they were a scam or they did not get developed further, so they are no longer there. And cryptocurrencies are generally not controlled by the federal or the state government or any central taxing authority. Before I go into the taxation of cryptocurrency, I think we should just understand a few popular terms that are used in this arena. The first one is wallet. A wallet is a device or an application which stores and encrypts the public or the private keys. So this is basically where your cryptocurrency is stored, and they track the ownership there. There are two types of wallets. One is a hot wallet and one is a cold wallet. A hot wallet is generally user-friendly. It's connected to the internet, but it's less secure because it's connected to the internet. Examples of that are Coinbase. A cold wallet is something which is not connected to the internet. It's hard to use, but it's more secure. And the examples of that would be Ledger Nano S. So it's basically, it could be a USB or a hard drive where you have it somewhere stored. The next concept is mining. Mining is a process where the computers actually solve this very, very complicated equations or calculations, and which is not possible by human mind. And then once they solve it correctly, they get rewarded with crypto, and that process is called mining. So the reward for solving these complicated transactions and getting it right, you get rewarded with crypto, and the process is called mining. Next slide, please. Some of the other terms which are really important to understand the taxation of cryptocurrency are hard wallet, soft wallet, and airdrop. You will hear these terms a lot when IRS FAQs. So a hard wallet is when a cryptocurrency actually goes through a protocol change and there's a permanent split in two, right? So it happens when there are codes that are changed and then your old version and your new version is no longer compatible. That means they cannot work together anymore. So Bitcoin so far has had 105 hard forks. Most of them were unsuccessful, but the two successful ones were Bitcoin Cash and Bitcoin Gold. So then the Bitcoin, you're splitting up actually like a fork into two pieces. One is Bitcoin and then Bitcoin Cash, and then subsequent there was Bitcoin Gold. A soft fork occurs when the software is copied and modified. How I can explain that is probably that you have your old rules, and then you have your new rules. But the old rules are actually grandfathered in along with the new rules. So even if you fall under the old rules or the new rules, the software is still compatible and there is no permanent split in the crypto. Airdrop finally is a mechanism where the cryptocurrency is actually put into your wallet and it's distributed to you. So about 10 days ago, the Irs chief, he was at a hearing, and he did say that he was going to crack down on cryptocurrency because he thinks that there are a significant number of taxpayers who are not reporting cryptocurrency. So Irs actually has introduced a question on your 1040 right at the top of the page, and it reads that at any time during 2020, did you receive, sell, exchange, or otherwise acquire any financial interest in any virtual currency? And you have to answer that question as yes or a no. Irs actually specifically has a FAQ on it. It's FAQ number 5, and it says that during 2020, I purchased virtual currency with real currency and I had no other transactions. Should I answer the question as yes? So the Irs FAQ says that if that was the only transaction you had, that you had money and you bought crypto, you don't have to answer that question as yes. You can leave it as no. But our recommendation would be to answer it yes, just to play it safe, so that your accountant is aware year after year that you actually are invested in cryptocurrency. And then we feel that the Irs FAQs and instructions don't carry much weight. So there's no harm in answering that question, yes, so everybody's aware of it. As I said, the cryptocurrency is almost like 12 years old, but the Irs guidance so far is very, very limited on it. You have noticed 2014-21. You have Revenue Ruling 2019-24, which basically gets into hard forks and soft forks. And then you have the Irs FAQs, about 46 of them that go into much detail of how cryptocurrency should be dealt with. So cryptocurrency or virtual currency is actually treated as a property, and that's why all the principles of property transactions apply to that. So basically, if you're selling, if you're exchanging virtual currency, you must recognize capital gain or loss on its sale, and then if your loss is over $3,000, you get to carry it forward. So if you have net short-term capital gain, it will be taxed on ordinary income. Net long-term capital gain, you'll get the preferential, right now, which is 20% tax rate. And then these gains will also be subject to your 3.8 net investment income. Most of these exchanges do not issue a 1099-B. So when we are filling out the forms in the tax return on Form 8949, we generally will check the box C, which says that these are short-term or long-term transactions that have not been reported on a 1099-B, and you are going to list each and every transaction separately. So I'll just go over a few examples. These are pretty simple examples. If you bought the cryptocurrency in 2021, at the beginning of the year, and you sold it in May for like $58,000, because it was bought and sold in the same year, you will need to report a short-term capital gain of $26,000. The same example, let's say you bought it in 2020 instead of 2021, you bought it for $7,000 and you sold the Bitcoin when it was $58,000. Here you would report a long-term capital gain of $51,000. I get this question a lot, can you pick and choose which unit you're trying to sell? And I think it's very important because as we know that these virtual currency exchanges are open 24/7, and depending on if you're trying to generate a loss or maybe report large capital gains this year before the tax rates go up, it's important that you can pick and choose your lot. So the Irs FAQ 39 and 40 say yes, you can do that as long as you have specific records that show the date and time each unit was acquired, your basis and fair market value of each unit, the date and time each unit was sold, exchanged, or disposed of, and the fair market value when you sold or exchanged this cryptocurrency and what value you received. So what happens if you don't have all this information? If you don't have all of this information, then you will follow first in, first out FIFO method of reporting your basis. So I'll go over an example where you're actually exchanging one coin for another, right? So I bought Bitcoin in January 1, 2020, when it was $7,000. On May 1, 2020, when the fair market value of the Bitcoin was $58,000, I had a magic crystal ball, and I knew that Elon Musk is going to tweet something which will bring down the value of cryptocurrency. So he's going to tweet that Tesla is no longer going to accept cryptocurrency because he thinks that Bitcoin uses too much energy and it's not environmental friendly, and he's going to stop accepting cryptocurrency for Tesla. So at that point, I knew that the value was going to go down. So I'm saying to myself that maybe I should invest in Ethereum. Ethereum is $2,000. It has the potential to go up. My money can double. So I'm going to exchange my Bitcoin for Ethereum. So here, even though I did not get physical cash, there is a transaction that happened where I exchanged my Bitcoin for Ethereum. So I still have to report capital gains on the original transaction. So it's almost as if I sold the Bitcoin, I took that money, and then I invested it back into Ethereum. So in this particular transaction, I'm going to report long-term capital gain because I held it over a year of $51,000. And then my basis in Ethereum will become $58,000, my original basis in the Bitcoin, plus any gain I reported. So there are other transactions also that could lead to reporting of ordinary income. The fair market value is generally reported as ordinary income. And these kind of transactions are when you provide somebody with a service and they pay you with a virtual currency. And this could also be subject to self-employment tax if you are an independent contractor. If your employer pays you with a virtual currency as wages, it will again be subject to your withholding tax. So generally, fair market value is determined at the date and time when the transaction recorded on the ledger or it hits your wallet. And then your income, which you report, becomes your basis. So let's say if Saks pays me $10,000 as in cryptocurrency fair market value wages, that $10,000 now becomes my basis in Bitcoin. And later on, when I sell it for $58,000, I'm going to report $48,000 as capital gain. And it could be short-term or long-term, depending on when I sell it. You also need to recognize gain or loss when you pay somebody with virtual currency for a service. So anytime you're having a transaction with a virtual currency or cryptocurrency, keep in mind that there would probably trigger a taxable transaction where a gain would need to be reported. Again, if you exchange any virtual currency, you will have to report. We talked about the definition of mining, right? So mining is split up into 2 or 3 categories. If you're using it as a hobby, like my colleague here, Michael, he thinks that taxation is not challenging enough, so he goes home and he does mining as a hobby. So if you're doing it as a hobby, you have to report it as ordinary income. It gets reported on your Schedule 1 of your Form 1040 as other income. Now, any expenses related to hobby are not deductible, as ordinary deductions. You have to take them as itemized deductions. So once you have anything that goes under the itemized deduction category, they will be subject to your 2% AGI limitation. So what you can deduct as expenses is very limited when you use mining, as a hobby. Whereas if that's all you're doing as a trade or business, your income or expenses will be reported on Schedule C. And just keep in mind, if it's Schedule C, it will be subject to self-employment tax as well. So we talked about hard forks and soft forks and airdrop before as a definition. So there is a revenue ruling where IRS has given how it's going to tax these particular events. So if you have a hard fork, right, but you did not receive any cryptocurrency, and we'll go over 2 examples after these slides, there is no taxable event because you did not get anything. But if you have a hard fork, which is followed by an airdrop, that means let's say you had Bitcoin and then it's split up into Bitcoin Gold, and Bitcoin Gold was actually deposited into your account. That particular Bitcoin Gold will have a fair market value on the time and date it was deposited. That fair market value is reported as ordinary income, and it will become your basis in crypto. Soft fork generally, does not result in any splits or any new cryptocurrency being generated, so it is not a taxable event. So just going over the examples in the revenue ruling, A holds 50 units of cryptocurrency M, which experiences a hard fork. It results in creation of crypto N. Crypto N is not airdropped or otherwise transferred to an account owned or controlled by A. So A actually does not get any crypto N, and he cannot transfer anything because he doesn't have it. So in this particular case, there's no taxable transaction. Next example is that, we had crypto R, we had 50 units of crypto R, and crypto R experienced a hard fork, which resulted in crypto S being generated. On that date, 25 units of crypto S are airdropped into B's ledger account, and now B has the ability to dispose of crypto S right away following the airdrop. So B now holds 50 units of crypto R and 25 units of crypto S. The fair market value of crypto S when it was airdropped was $50. So he's going to report that $50 as a fair market value as ordinary income. Just to keep in mind 2 things before I go into donation of cryptocurrencies is one is, sometimes these exchanges, they say that if you give your license information because they're trying to track you better, you will get $5 worth of Bitcoin as a gift or as a prize for that. Remember that $5 is also reported as ordinary income, and a lot of these exchanges like Coinbase, they give you these coins if you're learning about a new coin, right? So if you learn about an ETH, they say that you answer 5 questions and we are going to give you $10 worth of ETH. So that also is ordinary income and needs to be reported on Schedule 1 of your 1040. Donation of cryptocurrency. So if your holding period of a crypto is more than a year, it's going to be the fair market value. And if your crypto is held for 1 year or less, it's going to be the lesser of your basis or fair market value. Was sales, I think a lot of questions are being also asked on that, whether the sale or transactions of cryptocurrency are subject to was sales. So as of now, IRS has no official guidance on was sales, but all the commentary out there states that because cryptocurrency is a property and it's not treated as a stock or a security, the was sales rule do not apply. So that's the current guidance so far, or the commentary which we have, and that's how we are treating it. But just keep in mind, if you continuously are harvesting the tax laws, the IRS will come back and say that you're doing it on purpose, form over substance, and I'm going to disallow your loss anyway. So you just have to be careful if you have a lot of transactions, especially during the year end, where you're trying to harvest these tax losses. Going on to foreign reporting, based on the FinCEN Notice 2020-2, as of now, these cryptocurrencies are not reportable on foreign on FBAR. There are some, when you open up an account, you just have to be careful. Like Binance is one example. I think it's incorporated in Cayman Islands, so it becomes a foreign account. Binance US actually is in California, so you're okay with that. But as of now, you don't have to report these on your FBARs. But if you read the last line, it says that FinCEN intends to propose to amend the regulations regarding reporting of foreign financial accounts to include virtual currency as a type of reportable account. So we are anticipating that this change will come pretty soon, that you will be required to report any foreign accounts, which are virtual currency accounts, on the FBARs. Our recommendation, if you have a foreign account, it doesn't hurt. It's better to just report it and keep the reporting, or start the reporting right now. The other thing which is related to foreign reporting is Form 8938. This form is required if you have foreign financial assets of more than $50,000 as of the last day of the year, or more than $75,000 during the year if you're an unmarried taxpayer, and if you're married, those amounts are $100,000 and $150,000. So if you think that you have values of more than that in an overseas cryptocurrency account, that our recommendation would be to file a 8938, because IRS guidance is again not clear whether cryptocurrencies are required to be reported or not. There's a lot of talk about what IRS is doing to enforce cryptocurrency. So I'm just going to go over certain things that have happened. IRS has issued a John Doe summons to Coinbase to release transactions. And I believe those were from 2013 to 2017. Then the Federal Court of North District of California also entered into order with the Coinbase that they were supposed to provide data to the IRS for all the clients who were engaged in transactions of more than 20,000. I think the last I read, now IRS is actually going after a lot more exchanges, and they have actually lowered the limit from 20,000 to 10,000. Some of the taxpayers have already started to receive letters, and these letters have different numbers, right? So letters issued could be 6174. A 6174 is just informational letter, which actually tells you, how to tax how cryptocurrency is taxed. Is just informational. 6174A is actually, it's giving you the information on how cryptocurrency is taxed, but it's also giving you a warning saying, we can come back to you at a later date if we find something on you. And the letter to be scared of is the 6173, where IRS is telling you, we have information on you that you had transactions over a certain threshold and you have not reported them. So this is the place where you probably need to reach out to your accountant ASAP and maybe do some filings to report anything that was not reported. Next slide, please. My colleague here, Joy, was kind enough to share some of her thoughts on cryptocurrency and what state planning we can do with respect to these digital assets. So that I brought the Bitcoin at 7,000, I sold them at 58, and I have like millions of dollars sitting in my bank account now. And I've not told that to anybody, right? I'm waiting to see which of my kids are going to be nice to me, take care of me when I grow old. And maybe at that time, I'm going to disclose and give them these millions of dollars. So what happens if I pass away and nobody knows about this asset? These asset goes with me, and these millions of dollars go nowhere. So it's very, very important to update your last will and testament so that you're providing the consent to your fiduciary to access these accounts. Ensure that your fiduciary or whoever is going to be your executor has the details of the digital assets and knows that you have these cryptocurrency holdings. You may include express authorizations in your will so that the fiduciary can obtain the catalog of these electronic communications, so everything is not lost. A couple of slides on gifting and transfer of cryptocurrency. It also adds a little bit of complexity to it. Cryptocurrency, as we know, is very hard to value, right? These exchanges go on for 24/7, and the value could be like $30,000 of a Bitcoin in the morning, and it could be $60,000 in the evening. So Irs has indicated that it is going to accept the so-called explorer value of cryptocurrency, which is determined by analyzing the worldwide indices of cryptocurrency and calculate the value at the exact date and time of deemed transfer. So that's very important in this volatile cryptocurrency world. And then in case of state tax value, right, the cryptocurrency is based on the exact date and time of death and not the average value throughout the day of the death. And finally, a consideration is, cryptocurrency owning individually and moving it around could be difficult. So one of the recommendations which Joy had was probably, you can hold it in an LLC, because LLC transfers are very easy to happen. You can do them over the weekend. You just need assignment of interest for that. So I'm just going to briefly touch over taxation of cannabis with you. Since I made millions of dollars now, I'm trying to, diversify my portfolio, and I think cannabis is upcoming, so I decide to invest in cannabis. But before I do that, I need to just understand a few things about how cannabis is taxed, right? So in 1982, Congress enacted Section 280E, whereby no deduction or credit is allowed if an amount is paid or incurred during a taxable year to carry on any trade or business in controlled substance, right? So if you're dealing with controlled substance, you will not be allowed any deductions or expenses. So you have to report your gross revenue as income basically and pay tax on the whole thing. Now, controlled substances, Schedule 1 or 2, there are two schedules for controlled substances, and marijuana is actually classified as Schedule 1 controlled substance. So under Section 280E, most of the expenses which you incur to run your business will not be allowed. There is a little bit of grace provided in Regulation 1.61-3A, which says that your gross income is your total sales less your cost of goods sold. So basically, what you pay tax on, if you have a cannabis investment, it would be your cost of goods sold would be allowed as a deduction. So growers, producers, your wholesalers could probably deduct some of the cost, which we can classify as cost of goods sold. So what does cost of goods sold include? It includes the cost of your actual product, your shipping cost, maybe your irrigation cost, your direct expenses, like purchase of your seeds, your soil, etc. Cost of goods sold does not include advertising, repairs and maintenance, the salary you pay to your staff. That all is not included in cost of goods sold. So you will not be able to deduct any of these expenses. So just by the nature of these expenses being disallowed, I think a lot of planning needs to be done before you actually decide to set up a cannabis business, right? So what type of entity you need to set up? You need multiple entities because maybe you have some ancillary products you want to sell. You may want to open up a separate entity for these ancillary products so that all the expenses related to these ancillary products can be deducted. Meanwhile, on your growing side, only cost of goods sold could be deducted. And then it's very, very important to keep track on the nature of expenses because, as we said, only cost of goods sold are allowed as a deduction and everything else is disallowed. So this was like a very top side overview of cannabis. As I said, we probably will have something in the future which will go more detailed into taxation of cannabis. With that, we're going to go on to polling question number 2. If you had an extra $100,000, what would you invest it in? You would invest it in cryptocurrency, hedge fund that invest in cannabis, or would you pick real estate, stocks, or maybe play it safe and just put it in a fixed deposit? I have about 30% of the vote in. If you're looking for CPEs, please respond to the question. I'll just give it a few more seconds. We are at 75. Still a long way to go, only 77. Closing it in 5, 4, 3, 2, 1. Okay, so I think everybody's going to probably play it safe and invested in real estate and stocks and not cryptocurrency or cannabis anymore. With that, I'm going to hand it over to Craig to discuss the Biden tax proposals. Take it away, Craig.
Shivani, thank you. Thank you for that introduction, and thank you for a great presentation, and thank you all for joining today. As a quick introduction, again, my name is Craig Cassano. I'm a tax director here at Sachs. My focus is ultimately and primarily in the high net worth individual tax planning space. And what I wanted to discuss today are some of the proposals that are coming out of Washington in the Biden administration. And before I kind of break into it, what I wanted to lead with is just the simple fact that, you know, these are in fact proposals, right? And they're the initial step in Washington from a negotiations perspective with regards to where we may find ourselves from a tax landscape, call it, you know, late fall, you know, around that, you know, September, October, or potentially November range. But what we also want to do is emphasize how important it is, starting from today, to start thinking about your situation, reaching out to your Sachs advisors in order to plan and discuss how this could potentially impact you. A lot of these proposals have the potential to impact not only a substantial portion, if not all of our client base, but as well as, you know, all taxpayers out there. So it's very important that we really start thinking about this. Obviously, the caveat being we're not certain where things are going to fall out. We wish we all had that crystal ball. But it's the most important thing to keep in mind is that we really start to think about, from a planning perspective, how we can try to get out in front of some of these things. So with that being said, at the end of last month, the Treasury released the Green Book, which basically summarizes and goes through in a little bit more detail some of the items from the Biden administration's proposals. And out there, it discusses two particular areas: the American Families Plan, which focuses ultimately on individual tax reform, which we'll lead with, as well as the American Jobs Plan, which focuses more on corporate and international taxation reform. And both of these are kind of, you know, the target to kind of fund some of the infrastructure funding that has been going on. Next slide, please. So to kick it off, we'll start with individual tax reform, and the key thing to kind of keep in mind here is that the core of the proposal is to try and get income from labor, you know, obviously wages and things like that, as well as capital income that folks are earning, kind of on an equal playing field, right, wrong, or indifferent. So that's kind of the thing to keep in mind with you know, the Biden administration proposal perspective. So just to kind of start with where we currently are, the current tax brackets are ranging between 10% to 37%, scaling up, you know, based on different income levels. And the max rate there is set to go from 37% to 39.6% in the coming years. Under Biden's proposals, there's looking to be an acceleration of that to 39.6% for taxpayers making over $400,000. And that $400,000 is a key figure, and you'll see that sprinkled throughout the presentation, as that seems to be the target income There's times within the Green Book where the 400,000 is AGI or adjusted gross income, and there's times where it's taxable income. So there's a few inconsistencies with regards to what the folks in Washington are kind of considering income for purposes of some of these tax changes. And again, that 39.6 would, if it were to be enacted, would basically revert back to the 2017 tax brackets, with top bracket thresholds being 450,000 or so, give or take, for single filers, and about 510 or so for married filing joint. So as it relates to this specific item and this specific proposal, there's a few planning opportunities kind of right off the bat that we could potentially think about. And as we kind of just take a look at some of these bullets here, a couple of things that come to mind could be Roth conversions, gain harvesting, right? But with that, we kind of want to consider some return on investments and see from an economics and investments perspective whether or not it makes sense. Even though taxes are important, we don't always necessarily want to let the tax tail wag the dog. Deferral of loss harvesting, deferral of business expenses, things of that nature, installment sales. And we want to kind of think about, from a recognition of income perspective, timing as it relates to some of these changes. Next slide, please. So one of the biggest items that's out there that a lot of folks are definitely concerned about is as it relates to long-term capital gains and qualified dividends, which currently for a lot of taxpayers in the high net worth space are being taxed at a preferential rate of 20%. With a tack on of 3.8% for the net investment income tax. So part of the proposal is for taxpayers with AGI, and in this particular case, it's AGI, not taxable income, adjusted gross income, over $1 million. In that case, then capital gains and qualified dividends would then be taxed at a 37% rate. That's currently where the top ordinary rate is. If they would get both items on their wish list, if you will, and the ordinary rate will go up to 39.6%, then that 2.6% arbitrage would kick in. And just to kind of highlight an example as it relates to that, if you have a taxpayer with 900,000 of wages, 200,000 of long-term capital gains, obviously a total income of 1.1, you would have 100,000 of that capital gain income taxed at your current preferential rates of 20%. And 100,000 tax at ordinary income tax rates, which it's good to kind of see from the Green Book example that there wasn't necessarily a cliff there where it all would kind of fall into the bucket of ordinary once you hit that million number. From an effective date, this is pretty much one of the only items within the proposals that they're speaking about having kind of a retro effective date. Still some uncertainty with regards to when that would be. The book reads that it would be after date of announcement, which could be either April 28th, which was the first speech to joint session of Congress. The Green Book release date was May 28th, or it could potentially be some other date in the future. So we'll see where that ultimately falls out. And from a planning opportunity perspective, obviously taxpayers are going to want to kind of time realizations of capital assets, specifically if they would get their way and the enactment date would be retro, depending on how many gains are being set on. Just like any other tax year, as the year progresses, we would want to consider potentially harvesting some losses to offset and bring down that total income figure if possible. Next slide, please. So if you could recall from the campaign, there were several items that were addressed and spoken of. One of them, one of the bigger ones being the SALT, or state and local tax repeal. As you may recall, under TCJA, Tax Cuts and Jobs Act, there's a $10,000 cap as it relates to that. So part of the campaign was to eliminate that cap. That's not really spoken about within the proposals in Green Book. There was also discussion during campaigning of capping itemized deductions at overall at 28%. Also no discussion. Restoration of 3% piece limitation for anyone with income over 400,000, which is ultimately an overall limitation on one's itemized deductions. There was talk during campaigning of reinstating first-time homebuyer credit and expanded retirement savings credit. Also no mention of those. Next slide, please. So this is a big one. Obviously another thing and concern of a lot of our clients and a lot of folks that we're speaking to currently under current law. when someone passes away and they pass assets down to next generations, there's what's known as a step up in basis, which basically means that when heirs take on the assets of someone who passes away, they get a step up in basis to the fair market value of those assets at time of death. The proposals are out there to basically eliminate those step ups. There's also under current law, two of the ways, obviously, to transfer assets to other folks are both obviously from an inheritance perspective upon death. Also, gifting. Donors can gift it to donees, and what happens there is in the case of gifts, if someone were to gift something to a donee, the donor's basis in that gift would follow through to the donee, and the donor now hold that stock or whatever it may be with the same basis as the donor had at that time. And other than gift tax or eating into their lifetime estate and gift tax exemption, there would be no income or capital gain tax paid on that transfer. From an inheritance perspective, a similar concept, only the difference there obviously is that the basis then becomes the fair market value in the hands of the decedent's heirs. Under the proposals, what they're proposing to happen there is there would be a capital gains tax to be paid on any excess of the fair market value over the basis of that particular asset, which obviously would be something that we haven't seen before. And from a filing perspective, there's still some uncertainty as to how that would play out. Meaning, would that capital gain be included on an estate gift tax return, on the state tax return, on a gift tax return, or would it have its own separate filing, a capital gains separate type filing of some sort? The proposals also state that there would be about $1 million per person exclusion on this from a lifetime perspective, and this would all look to apply post December 31, 2021. So from a gift and estate tax planning perspective, and we'll get to estate and gift tax a little bit later, but just as it relates to this, as we start to think about this is even more so the reason to start to act and plan now, and reach out to your advisors in order to discuss estate plan. There's also within the proposal the potential to gain unrealized appreciation in trusts, partnerships, or other non-corporate entities if the property has not been subject to a recognition event in 90 years. So basically, just based on calendar and math, this would really not take into effect in theory until at least December 31st of 2030. But again, this is another area where they're looking to kind of tax that unrealized appreciation, in theory, really trying to halt the handing down of appreciated assets to next generations, and kind of that uneven distribution of wealth, if you will, which seems to be a big area that they're targeting within the proposals. Next slide, please. So as it relates to these appreciated property transfers, some of the proposed exclusions would be transfers to charity. No surprise there. Typically, that's one of the items that seem to be safe when it relates to a lot of these transfers. Also, obviously, if the decedent passes assets over to a surviving spouse, those would also fall under an exclusion. The $250 for single and $500 for married filing joint principal residence capital gain exclusion on sale of home is also still around, and no mention of the proposal of going away, as well as Section 1202 or qualified small business stock. That the exclusion surrounding that would also still apply as it relates under current law. Next slide, please. So another item that they target, which I think will impact a lot of taxpayers and the majority of folks that we work with here at SACS, is as it relates to net investment income tax, which came into play under the Obama administration and Affordable Care Act, which basically, just kind of referencing back to some earlier slides, net investment income tax is an additional 3.8% Medicare tax, if you will, on net investment income for taxpayers exceeding a certain income level. And basically, what the crux of this is ultimately what the Biden administration is proposing is that the net investment income tax or self-employment tax would apply to the vast majority of taxpayers with incomes exceeding a certain level, and there's that $400,000 number again. So basically, and there's a little chart there to kind of emphasize this donut hole, if you will, that kind of gets created from a potential revision of the net investment income tax rules. Currently, how it stands, if a taxpayer's AGI is less than 250, they would not be subject to NIT. So then this kind of in the middle now, if this were to be enacted, you would have a 250 to 399.9, where you would be subject to the current NIT rules. And then now if a taxpayer's AGI would fall above 400,000, you would be subject to the new net investment income tax rules, which are, certainly quite aggressive. Next slide, please. And again, just to kind of reiterate from a definition perspective, net investment income tax pretty much applies to all gross income and gains, from interest, dividends, capital gains, things of that nature. But with the proposal, with taxpayers making over a certain amount, they're shooting to hit folks with either a net investment income tax or self-employment tax on certain income, which otherwise under current law would not be paid. For example, with S corporation shareholders materially participating in a trade or business, they would be subject to self-employment taxes, which under current law is not the case. So again, not really sure where it'll all fall out, but certainly something to keep in mind and discuss with your advisors as well. Next slide, please. So a couple of the other items that are mentioned within the proposal. So under current law, which came with Tax Cuts and Jobs Act, there's what's known as an excess business loss limitation, which basically means that taxpayers are limited to a certain amount of business loss, if you will, that they can take against all of their other income up to their trade or business income for the year. $250 for single and $500,000 for married filing joint, and it's scaling up for inflation as the years progress. There was a little bit of a holiday or break in that for the past couple of years with COVID relief, but it is back for 2021. So it is important that folks are, Biden proposals aside, it's very important that folks are thinking about that as we move forward in the next few years. Just one thing to highlight there, in the event that taxpayers' losses are limited in a given year, that limitation gets carried forward to future years as a net operating loss deduction, which, this particular proposal, the budget estimate on this provision, that they're estimating that it could raise about $42 billion or so in revenue. But there's questions surrounding that, especially since the losses that are being carried over are carried over as NOL. So perhaps it's just a timing thing that they're referring to. There's also within the proposals taxing carried or profits interest for partners providing services within certain investment partnerships. Under TCJA, they had changed the rules on this a little bit under Section 1061, where in this particular similar set of facts, if taxpayers, if there was an interest within a certain investment for 3 years or longer, then they would continue to get that capital gain treatment. In this particular case, if taxpayers have that 400,000 number again over a taxable income figure, then the income would automatically become ordinary no matter how long the holding period is, and it would also be subject to self-employment tax. Also within the proposal is some penalty to U.S. companies for moving jobs overseas and elimination of certain deductions for overseas related jobs. Some changes to a lot of foreign tax items like FIDI and GILTI, which we won't really get to in depth, but just kind of from a GILTI perspective, a tax rate increase from 10.5% to 21%. There's also some items in the proposal to improve tax compliance and increase oversight of tax preparers. I will not steal Frank's thunder. He's going to touch on that slightly in his presentation. Next slide, please. From a corporation perspective, there's just simply put, there's proposed to be an increase in the tax rate from 21%, which is a flat rate currently, to 28% for tax years beginning after 12/31/21. There's also a proposal to impose a 15% minimum tax rate on worldwide book income for corps with income in excess of $2 billion. And that's basically to try to limit the disparity between what ends up being taxable income for corporations of this size versus what their book income is. So it's basically the government's way of getting a piece of revenue prior to big corporations being able to take advantage of some heavy duty tax planning. Next slide, please. And just very briefly, I'll skim over this one. Within the proposal as well, there's an expansion of tax credits that are out there. The earned income credit, proposal to make it permanent and expand it to some more folks. Dependent care credit to extend through 2025 and up the amounts a little bit, as well as income limitations. Next slide. Child tax credit as well, much the same. Extend that through 2025, as well as raise it a bit and expand it from an income as well as individuals who are eligible to receive. And with that will bring us to our polling question number 3. Which of the following Biden proposals concern you the most? Increase in long-term capital gain rates, lowering of the state gift tax exemptions, increase in income tax rates, all of the above, or none of the above? Or about 40% have voted. Numbers are climbing, which is nice. 60. This is a big one. Should expect to see 100%. About 10 seconds left. Okay, and we'll close in 5. All right. Okay, so it looks like the winner was all of the above, 64%, by a landslide. Okay, so I guess what I wanted to touch on, just very, very high level from an estate and gift tax proposal perspective, and our partner Joy Matok did a very lengthy presentation on this as well a few weeks back, which you could find on the SACS website. And I just wanted to really highlight and discuss a couple of the key talking points from that. So under our current situation for 2021, the exemption is $11.7 million per person, or $23.4 million per couple. And the exemption is basically the aggregate amount that can be given away during lifetime or at death. It's your estate and gift tax exemption. Now, under current law, this exemption is going to be automatically reduced in 2026. Congress is signaling, big interest in reducing that exemption and raising the ultimate tax rate, which is 40% now. So 2021 could indeed be our very last chance opportunity to take advantage of some very sizable, lifetime exemption amounts. Next slide, please. So for the 99.5% Act is shooting to lower the estate tax exemption from 11.7 to 3.5 and limiting the lifetime gifting to $1 million. So very important to see the difference between the two. There's also a proposal to increase the tax rates from a flat 40% to a graduated tax rate scale of 45 to 65%. So 40 to 65, as we could see, a huge jump. Also discussion to eliminate valuation discounts, which folks currently get, in transferring interest, whether it be to a family limited partnership or other type LLC interest, where there's certain discounts that can be taken for lack of marketability and minority discounts, things of that nature. Certain technical changes could really impact the effectiveness of planning techniques like grantor trust and grats, so something to keep in mind. And there's also out there potentially forcing a tax on assets and trusts after 50 years or so. And one thing to keep in mind is that portability would remain intact. Next slide, please. So the Sensible Taxation Equity Promotion, or STEP Act, which I had referenced in earlier slides, this kind of this kind of is repetitive to a lot of the stuff that that we see within the Biden proposal as it relates to imposing a capital gains tax on inherited assets, which we spoke about, and obviously that first $1 million of unrealized capital gains being exempt from that. And under that, it would allow taxpayers to pay in installments over 15 years to the extent that the tax applies to certain illiquid assets. So that's important to keep in mind. And there would in fact be a deduction against the state taxes for any capital gains taxes paid. Next slide, please. So again, just from a cliche perspective, as it relates to consulting the crystal ball, we don't have it. If we did, we'd certainly be picking Powerball and sharing it across the board. So we're just as anxious as everyone else to see where Washington ends up falling out and so on and so forth. But again, the point to really drive home here is that you should be in contact with, whether it be SACS or your advisor, your estate planning attorneys. It's extremely important that we're taking as much advantage as possible from a planning perspective, just so that we're kind of being proactive and out in front of a lot of this. And that will bring us to polling question number 4. Did your company take advantage of the employee retention credit? Yes, no, planning on it, not sure. About 80% with 10 seconds to go. 4, 3, 2, 1. Close it out. Okay. It looks like yes and not sure are kind of neck and neck. Or yes, no, and not sure, I should say. Okay. Well, thank you everyone for your time. I really appreciate it. I'm going to hand the mic over to Michael Benguigui, my esteemed colleague, who's going to speak to us a little bit about opportunity zones and 1031. Mike, take it away.
Thank you, Shivani and Craig. A lot of good stuff that we all need to start keeping in mind for our current and future tax planning opportunities. Good morning, everyone. My name is Michael Benguigui. I'm a senior tax manager and a member of the Sachs Real Estate Group. We want to give you an update on 2 deferral opportunities that are still out there, at least for now. That individuals or businesses that are involved in real estate, either as an investor or own real estate, should keep in mind and can still incorporate as a part of their overall tax planning. So just want to give the audience an update. The first one is in relation to opportunity zones. We're going to talk a little bit about the recent federal updates in terms of that, and what New York has come out in terms of their treatment of opportunity zones. And we're going to talk about the repeal of like-kind exchanges under the current budget plan. So now we're in June 15th. So if you're thinking of selling real estate and you want to do a like-kind exchange, you definitely want to listen up and see where things are going. All right, let's go to the next slide. Okay, so opportunity zones. Before we take a step forward, let's take a step back. TCJA, the Tax Cuts and Jobs Act, created opportunity zones to encourage investment in economically distressed areas by giving it tax incentives for taxpayers who invest and hold onto investments in the opportunity zone, which through a vehicle called a qualified opportunity fund. So a lot of times your broker can come to you and say, hey, listen, I know you got this big gain, you sold your business. I got this investment vehicle called a qualified opportunity fund. And why would one want to invest in a qualified opportunity fund, aside from being a good investment? So there are tax incentives. First tax incentive is basically if you invest today in June 15 of 2021, you're deferring your gain for the 2021 tax year. And most states incorporate the same federal deferral benefit. But we're going to talk about New York in a few minutes. You get a partial exclusion of the capital gain. So giving an example, you've excluded $1 million. That $1 million is due December 31st, 2026. The tax is paid in 2027. But 10% of that $1 million of the gain that is excluded, i.e. $100,000, that's permanently gone. So in 2026, you only got to pay $900,000. Now that 10% exclusion that I just mentioned, it ends for investments that are made on or before December 31st, 2021. So any investments that are made after 2021, you don't get that anymore. And the biggest tax incentive that are out there for opportunity zones is that if any investor that's holding an opportunity fund for at least 10 years, any of the capital gains, post-acquisition capital gains, any of that appreciation is permanently excluded. You don't have to pay income tax on those capital gains. So it's a very powerful tax incentive. You can use it as part of your estate planning that Craig just talked about, and it's still out there. So let's talk about some of the IRS recent updates in terms of opportunity zones. So opportunity zone funds, sponsors opportunity zones, and or investors that have invested in opportunity zones may have received a letter, and the letter number is 6250. And that letter is kind of important. Basically, it's saying in that letter is that if you're an opportunity fund, you're vindicated in your tax return that, hey, you're an opportunity fund, that you're that business, that partnership, S Corp, or corporate entity is elected to be an opportunity fund, but you're missing something. Either they didn't receive the 8996 form, which is the election form to be an opportunity fund, or there's a schedule missing that you should have included in there. If you're an investor and that's investing in opportunity zones, you're going to file form 8997. Though that letter is what I call a soft notice. It's not an audit notice, but the government's basically saying, look, listen, you've indicated that you're either deferring some capital gains or you're an opportunity fund, but we didn't get that schedule. We didn't get that election form. And that could have been because perhaps it was missing from the tax return because the software wasn't updated. Again, TCJA for members of our audience that were practicing, that were around. You can remember everything came very fast. So perhaps a software vendor didn't update their software, so the schedule wasn't transmitted correctly to the IRS. Or maybe there was some other issue that was missed. So basically, don't ignore that notice. If you do receive that letter, you should immediately consult with your tax advisor to help you resolve that. All right, next slide, please. Next slide, please. So let's talk a little bit about New York's treatment of opportunity zones. So New York initially conformed to qualified opportunity zone rules as part of the Tax Cuts and Jobs Act. But recently, New York passed their 2022 budget, and they basically said effective January 1st, 2021, so it's retroactive to the beginning of this tax year, we no longer adopt the opportunity zone rules from a federal standpoint. New York effectively decouples from the benefits of investing in an opportunity zone. So what does that mean? That basically means that if an investor has $1 million of capital gain and you've invested in an opportunity zone and you live in New York, then New York's basically going to say you got to pick up that gain now in 2021 tax year. And when you have to pick it up, that deferral on your 2026 federal return, New York is going to give you an exclusion. So you're not going to be taxed twice from New York's perspective. There is one nuance that's out there. That New York budget did not decouple in terms of the 10-year permanent deferral, at least for now. So we're hoping that that's something that was a purpose miss and a friendly miss for taxpayers that invest in opportunity zones. Next slide, please. So again, if you're a New York resident, or if you have investments that if you have an investment that you're deferring that is a tax from New York's perspective, there are two traps of the unwary that we want to introduce to our audience. So if one is a New York resident, pays New York tax, you have a capital gain, and let's say and you defer that capital gain, and let's say later that same New York resident moves to another state, let's say New Jersey, before 2026. So now you've paid your New York State tax on that sale, on that capital gain, let's say from sale of stock. You had to pay the tax because you're a New York resident, but now you're a New Jersey resident on or before 2026. New Jersey follows federal. to give you an example. New Jersey might tax you twice because you're a resident of New Jersey. New Jersey might come in and say, you know what, that gain that you're picking from federal, we may have to tax you on that as well. Again, that's something to be cognizant about. So there is some double taxation there. Another situation would be, let's say an investor sold a property that's sourced to New York or located in New York real estate, and that capital gain is sourced to New York. Even if that investor lives in another state, let's say in New Jersey, you're still going to have to pay tax on that gain, and New York would then give you an exclusion in 2026. However, New Jersey does not follow the same New York mandate. So again, New Jersey follows federal by means of example. That's another situation you have to pay double tax. Next slide, please. So repeal of like-kind exchanges. Let's talk a little bit about that. If you're an owner of real estate right now and you want to sell your real estate, and that appreciated real estate you want to move in, you want to move it to, you want to defer that capital gain, and you don't want to use an opportunity zone, you can effectively buy another real estate asset or another real property, and you're basically deferring the gain from real estate that you sold, your relinquished property, and you're purchasing a like-kind replacement property. Prior to the Tax Cuts and Jobs Act, it was not limited to just real estate. It actually included other items, personal property, trucks. If you're manufacturing or in the construction industry, you might have trucks. When you traded in that truck and you fully depreciated, there was gain there, and you could have deferred that gain to be part of the acquisition of the new truck. Now that's gone. Even if you go back in the 1990s, you could have one could have sold a domestic U.S. real property and bought a foreign placement property. That you can't do that now. It looks like Congress and the previous administrations and the current administration is moving forward that they want to minimize that like-kind exchange deferral. Again, it was from a few years ago. It was basically any industry could use it. Now it's basically just the real estate industry that can use this type of deferral. The current proposal right now is basically that like-kind exchange deferral is up to the aggregate gain of $500,000 for each taxpayer, $1 million in the case of married individuals filing joint returns. So again, if one's part of a like-kind exchange, taxpayer can only defer $500,000. If that taxpayer is married, it's $1 million. Any gains from like-kind exchange in excess of $500,000 or $1 million in the case of married individuals filing a joint return during the taxable year would be recognized by the tax year in the tax year that the transfer of the real property occurs. So if it's more than $500,000 being deferred in the year of the exchange, you gotta have to pay the access in tax. This is effective for exchanges completed in taxable years beginning after December 31st, 2021. So there's a lot of things there to think about. Let's go to the next slide, please. So under this read, let's just think this through. A new rule would apply to exchanges that are completed. So this is when the exchanges are completed. So now we're in June 15th. If you start a like-kind exchange in the next after July 1st, and that exchange is completed within 180 days. So let's say it's July 15th. The last day of July 15th will be somewhere in 2022. So if this becomes law, your like-kind exchange that you started in the middle of July of 2021, now you fall into the situation that it's only $500,000 of that gain per taxpayer that's excludable, that's deferred. Everything in excess of that, you got to pay capital gain. So again, this is something we got to be cognizant about in these types of transactions that we're coming into like-kind exchanges. This does become law, or it may look like it becomes law. This provision appears in the Green Book section that's addressing taxation of high-income individuals. So does that mean that this will not apply to corporations? So if let's say a corporation was making the like-kind exchange, could a corporation defer more than $500,000? And the term taxpayers in person can be read to include corporations and partnerships, which would mean that perhaps that $500,000 really is per person, per owner. So to give you an example, a family partnership with 2 parents and 3 children as partners would each get a $500,000 exclusion. Is that what it means? All right, next slide, please. With that, let's go through our CP poll number 5. What are you looking forward to the most post-pandemic? Please select one of the following: dining at restaurants, vacations, going back to the office, Broadway shows, concerts, and etc. I don't know about you folks, but I'm looking more towards the vacations, but that's just me. All right, everybody, we got 10 seconds left and 78% have voted in. Can do better. Polls closed, please. So 76% of our attendees are looking forward for vacations, and we all should. With that, I'm going to pass to my colleague, Frank Sanchala. Frank, take it away.
Thank you very much, Mike. I appreciate it. Good morning, everyone. We're fortunately at the last part of our presentation. Wanted to thank everyone, Shivani, Craig, and Mike, for spending time pulling this all together to kind of give us a crystal ball look at what potentially is coming down the road. As you can tell by their presentations, these changes are coming, and I have to be very honest, IRS enforcement will be ratcheting up. Please go to the next slide. There are several recent developments that happened, and more coming down the line. Just like you and I were impacted by COVID-19, COVID-19 wreaked havoc on the IRS, and there's been tremendous problems. I'm sure everyone's aware, but I would like to focus on some of the highlights of what's currently occurring, and then some of the proposals that are coming down the road with the Green Book and some of the Senate's finance conferences that happened earlier this year. Next slide. All right, so some of the recent challenges for the IRS is they've had to go to a remote auditing style, and considering how old their technology is, the challenges and the timing of getting everything done has delayed the processing tremendously. Also, last year at this time, there was tremendous backlash against the IRS from Congress about the audits of who was being audited, and they kind of read the Riot Act that no high-income earners and partnerships were being audited. So the IRS spent the last 6 months to a year retraining all of the auditors to focus on partnerships, and they were focusing on basis, which means if you could deduct losses and certain other things associated with these partnerships, dealt with rules that impact real estate professionals, when assets were sold during the year, and if taxpayers were taking cost segregation studies or other advanced depreciation deductions. So there have been numerous audits. We've had a half dozen in our own firm kick up within the last few months. So I would be expecting to see more and more of this. And as part of these audits, the IRS is asking us to prove all these things. So it's a lot more work for both the taxpayer and us as SACs to prove that we're entitled to these deductions. And I know Shivani spoke at length about cryptocurrency. I'm going to be talking about that too. The John Doe letters being issued for cryptocurrency. There's two different focuses on that. The IRS is seeing this as an FBAR type of reporting thing, and this was big 15 years ago when the IRS launched these programs. There's probably going to be some programs launched down the road because they see this as not only an underreporting of income, but potential fraud and criminal activity. So the IRS is going to be devoting quite a bit of time to deal with cryptocurrency. Next, please. One little thing I want to touch upon is what's known as the statute of limitations. And I'm not going to read the definition. It's basically a term where the IRS or the state can come back and examine your return, or you could do an amended return to claim some money back. Go to the next slide, please. Okay, just as a general overview, the statute of limitations for federal purposes is 3 years. What most people are not realizing, and it's very important, that the statute of limitations doesn't get extended for weekends, holidays, and certain postponements. One of those being COVID-19. Without an extension to file a return, your statute of limitations ends on April 15th, 3 years after. So the reason why I brought that up is because obviously last year for the 19 file season, everything was done in July 15th was the due date. But if you need to file a refund claim because something comes up, the statute of limitations ends April 15th. Now, the other reason I want to compare that is when we look to the state of New Jersey, some of you may be aware of this already, but you have to be mindful of this. New Jersey declared a state of emergency in March of 2020, which basically suspended the statute of limitations. And this suspension will not change until the governor signs an order to suspend it and 90 days after that. So basically what that means in English is for 2016, if you file a 2016 return on time, Irs can examine and review it. New Jersey can. If New Jersey audits your 2018 return, they can go back and look at 17 and 16 and expand their audit. So basically, they no longer have a 3-year look back period. They have a 4-year look back. So it's creating a lot of challenges for us as a firm, but as taxpayers, you should be aware of that as well. Go to the next slide, please. Okay, Irs and the Senate Finance Committee talked about a lot of different things over the last couple of months. The tax gap was mentioned, which is basically the difference from what the IRS has collected versus what they should have collected. The last time they measured this was almost 10 years ago. It was at $441 billion. The Irs commissioner testified to the Senate Finance Committee that this should exceed $1 trillion right now. So obviously, in all the proposals you have seen mentioned, especially by Craig, between Biden and all these recommendations, there's going to be a lot of changes to enforcement. I will be continuing to go through that. One ironic comment that was made by the chairman of the Senate Finance Committee is when he looked at the millions of partnership returns filed in 2018, there were only 140 partnership returns audited during that year. Now, the audit regime has changed since then, so it's much easier for the IRS to audit, but the IRS has been taken to task on that, so there'll be a new focus in this area. So it's coming, expected. If you have any questions on it, feel free to reach out to us at any time. Interesting, I'm going to talk about quickly the Taxpayer Advocate Report that was also mentioned at the time. And I'm sure there's some of you out there who are wondering why they haven't gotten their refunds yet. And a lot of the IRS software is not very up to date. And the Taxpayer Advocate's Office criticized the IRS pretty harshly for creating unnecessary delays because they're flagging software for fraud. It could be 20 to 30 years old. And as I mentioned, the IRS is asking for tools to crack down on the fraud with cryptocurrency. So the following solutions were proposed. Next slide, please. There'll be an increase in IRS funding. The Senate Finance Committee and the IRS felt that for every $1 they spent in funding, they would get $4 returned from compliance and extra audits. So that's something for us to look forward to. So I would expect the audit rate to go up, which is right now 1% on a return. It's going to probably go up because now there are more bodies to do some of these audits. The IRS will also be requesting financial institutions to increase their level of reporting. This includes cryptocurrency, this includes stock options, this includes a lot of different items which right now do not get sent to the IRS. The IRS is looking to make sure that they are getting all this information to them, and rightfully so, because it is true. It's with the cryptocurrencies we mentioned, it's very easy to hide these transactions because there's no consistent reporting mechanism for all the different exchanges and currencies. You know, there are over 2,000, 3,000 of them, many of which have been shut down. It's next to impossible for them to track this. So they're looking for enforcement starting in 2023. Next slide, please. Listed transactions, don't need to go into that, but it's basically where the IRS has identified a tax avoidance scheme and taxpayers participate in it. And The IRS is looking to crack down on that. They don't want to give any more people flexibility on this. The rest of these rules don't apply to you so much. Next, please, slide. The IRS is also going to be regulating tax preparers one more time. Not necessarily overly interesting, except for the fact that the IRS can now charge the tax preparers again for e-filing returns. So that increases the cost to everyone going across. So something else to think about. Next. Okay, the Taxpayer Advocate's Office delineated quite a number of problems with the IRS right now, including the fact that apparently nobody wants to work with them. Their software was outdated. Go to the next slide a minute. I just want to highlight one thing quickly. The IRS, in the middle slide, I don't know if anyone has filed an amended return since COVID began, but I'm sure you're aware that it's taking a very long time to get this done. Pre-COVID, it would take the IRS 29 weeks to process an amended return and give you a refund. Since COVID, this has increased to 8 months, and I will tell you there are some that have exceeded 12 to 14 months. The IRS is aware of it. Taxpayers Advocate Services are really after them on this. There's only so much we seem to be able to do because the number of employees there, but this is a tremendous problem for the IRS, and it's hopefully going to be addressed. Next slide. Okay, that's some of the update that we talked about with the IRS. The remaining thing I just wanted to mention is this new workaround that the states have come up with to allow taxpayers in certain circumstances to deduct their state income taxes in excess of $10,000. So back in the beginning of 2018, when TCJA came out, they limited itemized deductions to $10,000. Everyone basically was no longer able to itemize, or they got no benefit for the state income tax deduction, especially in high income tax states, which most people on this call are involved in. So what the Connecticut decided to do, and they were the first state in this arena, is create an entity level tax. So they estimated what the tax liability would be for your business income. This business income was only applicable for partnerships and S corporations, single member LLCs and C corporations. This did not apply to. And then they levied a tax that you would pay with the partnership or S corporation return, which would be deductible for federal purposes. In Connecticut, this was mandatory. You had no options to elect out of it. In the end, what this would do is most of the states would also benefit because they would get increased revenue, not only from a more predictable stream, a more consistent way to get this revenue, but they won't always allow equivalent credits on their returns. This has become very popular. Many states were developing and interested in this. But a lot of states held off until later last year, where an IRS Notice 2020-75 was issued, confirming that the IRS would allow this type of setup to work, and it would be able to work around the $10,000 state income tax limitation. Just go to the next slide, please. So far, all those states have adopted. What's interesting to note is Connecticut is the only state that requires this and keeps this as mandatory. New Jersey adopted their system last year. New York is adopting it this year. You can see all the states that are out there. This is increasing daily as South Carolina came out Monday. So I would expect this to be more and more prevalent as time goes on. Just several things to keep in mind. You have a single member LLC. You do not get a benefit for this provision. So obviously, you want to look to become a regarded entity, either a partnership or an S corporation, to take advantage of this. There is some issue with states, certain states not allowing a credit for taxes paid in this regime. New York was notorious for putting verbiage or inconsistent verbiage in their code saying that they would audit the taxes unpaid in this regime for Connecticut and New Jersey and disallow it. They're going to be coming out with additional guidance on that in the future, but that still exists. They're not the only state, but we'll keep you attuned to that, see what happens. And in some states, this mechanism can actually result in the taxpayer grossly overpaying their state liability and having to wait for refunds to that state. So there is a timing issue with that. It's not the worst thing in the world. Obviously, the federal deduction offsets the overpayment of tax, but it's still an issue for some taxpayers. Okay, next please. And that's it. Now we're at our last polling question. What would you like the frequency of Tax Is Taxed webinar series to be? Monthly, quarterly, semi-annual, or annual? Uh-oh. About halfway there. Okay, we got about 10 seconds left. So remember, you need this for your CPE if you want it. Interesting results. Time.
With that, we're almost at the end of our webinar. We got a lot of questions asking us about the slides and the presentation. As I said at the beginning of my webinar, that within 24 hours, you will get a recorded copy of this webinar along with the slides. And there were a few questions on cryptocurrency, basically saying where we can find the Irs guidance. I have the guidance in the slides, and if you research it on the Irs websites, they will come up once you reference those. And there was also a question about the number, the course number, which you have to use in the CPE. You can just leave it blank, and when we get it, we will fill it up at our end. So I know we went through a lot of material today. Hopefully you got a chance to write down your to-dos, your action items, or your follow-ups. But if you have any further questions, feel free to reach out to us at the email below. Shivani, Craig, Michael, and Frank, all of us, you can reach out to us directly and we will respond to any questions. And if you have any questions that are unanswered as of now, we will reach out to you shortly after the presentation in a couple of days. So with that, thank you, and signing off for this session.